last year saw the second lowest number of single-family homes sold in a one-year period in San Ramon. I'm Tony with Clarkson Santoro, and this is our first San Ramon real estate update for 2023. In this series, we update you on the latest trends that are occurring in our real estate market here in San Ramon. Using our more than 50 combined years of experience helping clients buy and sell homes, we explain what those trends mean for you as a homeowner or as someone looking for a house that you will love to call home. This week, we are going to review how the market was last year, and we will get back to our routine of weekly real estate updates next week. Like I mentioned in the intro, the year 2022 saw the second lowest number of single-family homes sold in the last 24 years. The lowest year for sales was 2001, the year of 9/11, and the last year actually tied for the second lowest with 2008, which was the true start of the Great Recession, at just 586 homes. Usually, with lower sales numbers, you will see an increase in standing inventory and a slower turnover rate. But that was not the case for much of the year. Not only were sales down, but people were not placing their homes on the market in the same numbers as in previous years. It seems that people are not moving as often because it has become too expensive to sell and move. The first quarter of the year saw dramatic price appreciation. The 30-day rolling average of single-family homes began the year at 1,930,000. It skyrocketed to 2,397,000 by May 23rd, an increase of 466,000 or 24% in less than 5 months. That growth rate was simply too good to be sustainable. It was clear to those who were watching the market that changes were well underway prior to the run-up in late May. As the following chart demonstrates, the number of pending sales dropped off precipitously in March, indicating that the bidding wars of early spring would be subsiding. With the drop in competing offers, the significant amounts of over-asking being offered by buyers retreated from 50% over-asking down to 80,000 or 3% under-asking in less than 2 months. This retreat was not just a function of fewer buyers. It was also fueled by an explosion of inventory. First, the middle of May saw the beginning of a huge run-up in inventory that peaked in late July. In just over 2 months, the number of homes on the market increased by almost a factor of 6, from 21 homes to 118 homes. Pending sales reached their peak in mid-April and then began to drop off just as the inventory was taking off. The result was a reversal in the market's momentum. One of the most important indicators of a market's health is the rate that the inventory turns over. This is a function of total inventory over the number of pending sales using the 30-day average. In a normal market, the inventory turns over on average of about once a month. On this chart, an average turnover rate would be represented by the number 1 on the left column. The year began with a very low inventory and strong sales, driving the market turnover rate to nearly 6 times the norm. Near the end of January, the market appeared to be headed back to the normal range of turnover, but it took off 2 more times, rising above 4 in February and then again in early April. The market continued to be very strong until about May 10th, when it suddenly fell from 4.5 times normal to about 1/3 of a normal. Since mid-June, the market struggled twice to reach a normal turnover rate, but since November 10th, the market has slowed to a crawl. One last metric to examine is the amount of money a buyer bids over or under the asking price. Buyers were driven to bid over asking for 2 reasons. One is that they were competing against other motivated buyers, many of whom have lost out on previous bidding wars. The second reason is that listing agents were placing homes on the market under their expected sales price to encourage more offers. The irony is that if the home was placed on the market at a fair price for their home during the hottest period of the year, buyers would be discouraged to make an offer on that house. They would end up thinking that they would have to pay an additional 10% or more for a house that appeared to already be overpriced. As a consequence, most sellers underpriced their home by at least 5% and were usually rewarded with multiple offers. At the start of the year, buyers were paying on average over $200,000 above the asking price. This peaked above $300,000 twice, once in March and then in May, but it suddenly changed and declined dramatically until late August, when it settled out at about $80,000 under the asking price. The question that comes to mind is, what happened? I think it is just as important to ask what didn't happen in regard to last year. The stock market experienced its worst year since the Great Recession of 2008. High-tech stocks took the worst hits, and the Silicon Valley economy is treading water at best. Interest rates, which were at historic lows in 2021, have more than doubled, crushing the ability of step-up buyers to incrementally improve their housing situation. Federal and state capital gains tax rates are an unexpected expense for sellers who enjoyed huge run-ups in their property values. The house that they bought for $500,000 15 years ago is now worth $1.7 million or more, but the capital gains tax takes a large amount of their proceeds. The greater the gain after the homeowner exemption, the greater the tax. The final discouraging blow for step-up buyers under the age of 55 is the change in their property taxes. As an example, their old house purchased for $500,000 has a current property tax bill of about $9,000. If they then sell their home for $1.7 million and move up to a $2.2 million home, their new property tax bill will be about $27,500. That huge increase in property taxes is discouraging step-up buyers from making that move. This quadruple whammy of higher interest rates, stock market losses, potential capital gains taxes, and the dramatic increase in property taxes is discouraging all but a very few motivated step-up buyers. For those property owners over the age of 55, many of the limiting factors above do not apply. Because of the California Proposition 19, sellers over the age of 55 can move up to another home and avoid the increase in property taxes for the most part. Each case is potentially different, so get tax advice after the age of 55. Plus, if you own your home free and clear and use cash to buy your next home, you'll avoid the costly increase in interest rates. For these reasons, I expect that we will see substantially more activity than normal from the property owners in the plus 55 age cohort, as they age out of their homes and make plans to find appropriate single-story, low-maintenance homes for their golden years. I hope this year-end review helped you understand how our market is affecting your options. Let me know in the comments down below or contact us directly if you have specific questions about how you can navigate this market to sell or buy a home. And if you find this information helpful, remember to share it with a friend and hit the like and subscribe button so you'll always be up to date on the latest real estate news here in San Ramon. Have a safe weekend. We'll see you next week with a new update.